first we have the lender panel, and then we have the investor panel. We've gotten all excited and hyped up about hotel investment in Africa over the last 2 days. Now we actually need to find the money to implement that. So over the next 35 minutes or so, I'm going to be interrogating my panel here and hopefully getting your support on that as well through some questions from the floor. Really with the focus on what's happening in the lending space. So my name is Xander Nijnens, and I head up JLL Hotels and Hospitality Group for the region. We advise on various transactions. We've done about $500 million worth of transactions in the last 3 years, and probably worked with quite a few of the panelists on the stage here. Just to give you a quick introduction, we have Peter from KCB, then we have Godfrey from IFC, Claire from Proparco, Oteng from Norsad, and we have Sarah from Afreximbank. Yes. So I think I count 3 DFIs, technically one more impact investor, not a DFI, and we have 1 commercial bank. So it's a great mixed panel. And I think what we're going to do is jump straight into it. Claire, to start off with you. You know, Proparco is a development finance institution or DFI. How do you look at the hotel sector, and how do you measure your success in terms of your role in facilitating investments in the hotel sector?
Within Proparco, we've been supporting hospitality sector for more than 10 years now. It's definitely one of our priority sectors, all the more in Africa, because Africa is one of the French government priorities, supporting development in Africa. So what we see for hospitality is that we are dedicated to support projects with high impact and be exemplary in terms of setting up and spreading the best international standards on the markets we are supporting.
Okay, and what does that, does it mean you're looking for job creation? Are you looking for economic impact? What are some of the measures that you look for in terms of a successful project?
In our mandate, obviously job creation is a big criteria for our intervention. But beyond that, we look at all ENS impacts we can have, which means that for hospitality, a project we can show high standards in terms of building, construction, energy, waste management, etc. Will be a clear plus for the project. And basically, yes, job creation, supply chain also. How do you source your raw material for your project, and then for the operations? This is all the spectrum of impacts we are looking at.
So quite a lot of sustainability and environmental issues that get involved in terms of your decision whether to lend. And Oteng, so you were very specific. You're an impact investor, yes, not a DFI. Are you on the correct panel? Can you talk us a little bit through, you know, when you lend, what role you would play in terms of supporting development?
Okay, I'll just add, in addition to what Claire mentioned from an impact standpoint, we believe that tourism is the sort of the next industry from an African standpoint, given that most of our economies are actually exposed to resource cycles. We think that tourism actually plays a major role to sort of stabilize the economies. So we have, our thesis is that tourism, which obviously works hand in hand with hoteling, are critical for driving diversification in our markets. The role that we play as a mezzanine provider is just as a catalyst on the transactions. And most of the time we sort of, for projects where the promoter has some equity and they have a shortage, we will come in at company level and push down at project level, let's say, to increase that equity position. We also have found ourselves doing a bit of debt in some markets where the loan tenors are actually very short. So we will come in and provide a senior debt tranche together with our MES tranche. So that's sort of, we more of a catalyst in the whole process.
Okay. And in terms of the projects that you've lent on within the hotel space, has that been more MES or more senior debts or?
I'd say it's been more, if you look at the quantum, it's been more senior debt. Just largely, if you look at most of the markets, it's very difficult to find long-term debt. Yeah. And we find ourselves having to provide that.
Okay, great. Godfrey, I guess you guys are very much in the senior debt side of the equation, not so much on the MES side. Mm-hmm. Sometimes equity, but probably more on a platform basis. How do you go about as IFC picking your winning projects and the ones that you look to take forward from a financing point of view?
Thank you very much. I think it is important to point out that IFC has been involved in the hotel sector for quite a long time, since its formation. Interestingly, actually, our very first hotel investment was here in Kenya, the Intercontinental, in the 60s. Since then, we've done over around 280 hotel investments globally, to the tune of about 3 billion of on account and mobilization. Okay. Over 100 of those in Africa. So, Africa is a space that we know quite well. The key considerations for us, obviously, I think for any engagement or project that we get involved in, KYC is obviously an important departure point. But most fundamentally for us is there a market for the product? Because it's no longer a situation of build it, they will come. For us, understanding the market dynamics is key, given that we've done a lot of transactions in this market. So effectively, we would want to understand what is the demand before we engage, but also what is the supply situation compared to demand. What is the picture in terms of your the behavior of your ADR as occupancies in that specific market. And that information is normally, easy to, based on our experience, easy to find on the basis of, your reports with STR and previous, projects that would have been involved in. But most fundamentally as well is, you're building a product for a market. What is the cost of that project? What is the market prepared to pay? So the relationship between cost and your return is important. So you can build a Rolls Royce for a low-end market, and it won't work. So it's important to ensure that there's alignment in that regard. And also hotels are typically quite capital intensive. So IFC's traditional approach has been to provide senior debt. But we're also quite, cognizant of the fact that you need to accommodate your construction period and your ramp up. So we give the necessary grace period and appropriate tenor for the repayment of principal.
Okay, so very much a fundamentals approach, right? Starting off, who's the jockey? Is it somebody you can do business with? What's their experience? Mm-hmm. Looking at the industry, looking at the product, mm-hmm. and ultimately the feasibility of the product, the project that's going to be driving your interest. Sure. Great. And Peter, I guess from a KCB point of view, you are technically the most commercial lender within the panel. Do you take a similar approach? Is a lot of your focus on the sector based on the existing relationships you have with clients, or are you actively looking for new projects?
Thank you very much. Yes, at KCB, we take an active role within the sector. What I would say, the lending principles generally are the same across the institutions. Now, looking at our total book and our exposure in this market, we have close to 4.2 billion already, not specifically within the hotel industry, But about 10% of that, about 400 million, that is within the hotel sector. When it comes to lending, we are looking at the viability of this investment. We look at the feasibilities that we have. You're looking at the supply, the demand-supply situation. But most importantly, we cannot ignore certain dynamics within the market, things like the security situation in a country. You're looking at the advisories, all those things that may hamper. But currently, the market is so good to us, we're on a growth or within that particular area.
Okay, great.
Sector.
And when you, so I guess you look after the broader real estate sector, and you have a broader exposure to different asset classes. At the moment, like, in terms of your focus on East Africa, would you say you're looking to increase your exposure to hotels versus other classes, asset classes, or how do you view hotels within the broader real estate spectrum?
One, I would like to say that KCB is the largest bank within the region. We're in Kenya, and we're in the larger East African region. Yeah. Within all that, we are actively involved in supporting the sector. And at the moment, we have a heavy pipeline, which we are pushing to completion.
Okay. Okay, great. Just to talk a little bit about, access to finance. Generally, a lot of the investors that we talk to and developers we talk to can find it frustrating to deal with some lenders and some DFIs. So important just to discuss that. So, I mean, Sarah, just because you're talking at the end, in terms of process and how long it takes from application to drawdown, whether it's from an industry perspective or Afrexim, do you think that there are genuine concerns, or do you think that there's a fair due diligence process and a clear timeline that our developers need to keep in mind?
How come I get to be on the spot? It's not, in my view, and the experiences I've had, it's always not a straightforward process. There are always so many parties that are involved. There's always a lot of documentation that needs to be reviewed and documentation that needs to be put in place. So it's not the kind of application that you get on your desk and you're able to do a desktop analysis and you get the financing done within a couple of weeks. You need to have due diligence that needs to get done to determine the viability of the project. And that involves bringing in other parties to the table to be able to do the due diligence. That takes a bit of time, and in most cases, it takes a lot of going back and forth. In Afreximbank, speaking to Afreximbank, it's, we have a unique way of supporting the hospitality sector. So we don't finance directly the construction of a hotel. What we do is we partner up with either a contractor or a financier who's able to provide the financing. And then on the back of that, we're able to provide a guarantee because Afreximbank cannot take up construction risk. So once the construction is done, then we are able to refinance whoever the financier was, and we take over the operational risk. So in such a situation, you're talking about so many different parties that are involved. It's not easy to put a time frame to when, from the time you receive the application to the time that you do the disbursement. Yeah. It's impossible to put a time frame to that. Yeah. There are a lot of parties involved, a lot of negotiations, a lot of back and forth that goes on.
Okay. And I guess
I may add something to what you said, Sarah. There are some possibilities to speed up the process if you come and see us with your project and that market studies, feasibility studies, impact assessments, etc. are done, your project manager is appointed, etc. Yeah. The things will move much faster for us, and we'll be able to be much more agile in the process.
And I guess, I mean, you come from a commercial lender background, right? I mean, I think you were with HSBC before Proparco. In terms of process that the DFIs would go through versus commercial banks, very much the same process, same timelines, or have you found a difference in going into the DFI sector?
There is a difference, but I think it's necessary because we take the time for each project to think of how this project enters into our global mandate, what will be the impact, if this is in line with what we want to do as a DFI, as a French DFI. So we put on the table much more people than in a commercial bank, sorry. And we want to make sure that first the project fits, and second, what can we do to improve the project and maybe bring additional assistance to the sponsor, to the project, for it to be even more impacting, actually.
Okay, it's more of an active partner. Oteng, you wanted to add?
I was going to add to the previous point on how long it takes to actually disperse. One of the great frustrations for us is actually around lack of equity. Essentially, you find that you receive a project and the promoter has not raised sufficient equity. And sometimes for us, and it depends on the opportunity and the market, there are priority markets for us. For those markets, sometimes you can actually go through our credit process and approve a transaction on the basis that they raise the equity as a CP. Then you go months and sometimes years where the person cannot find the necessary equity. So just to support what Sarah was saying, it's impossible also because of the level of readiness of projects. And unfortunately in our market, some of the regulations are still evolving. I'll give you an example for EIA, for instance. It's a fairly new thing in Malawi, which was introduced in the middle of a project that we're looking to approve. So that also delays the project. But in general, you find that promoters sometimes don't have all the necessary approvals to actually support you dispersing right away.
Okay. And you say, talk about promoters not having sufficient equity available. What sort of equity are you looking for in projects? Are you talking 50-50? How far would you normally go?
So for us, it's a bit tricky because we do support to top up the equity sometimes with a mass tranche, as I think I mentioned earlier. It's a function of the opportunity, that the demand in that market. So where we feel that it's a very, very good market, the demand is very high, we can actually go low on the equity requirements. But in a market where we feel it's just a normal market without being any exceptions, we would look for about 40-45% equity if we're going to bring just the senior tranche. Yep. But if we bring in mass, we can allow you to go back to 30. But again, it's a function of the opportunity.
Yeah. Okay. Great. Peter, in terms of the commercial lending side, is that similar type of numbers you're looking for? I guess a lot of times you already have the broader banking relationship with your clients and a bigger balance sheet to leverage off. How do you normally look at equity contribution versus the debt funding?
Thank you. At KCB, we'll look at equity contribution normally up to about 50%. But again, the cash flows must be strong enough where you find the cash flows cannot sustain that kind of a repayment of a tenure of about 8 to 10 years. We may demand more contribution, but where the cash flows are strong, at times we'll go up to about 70% on equity.
Okay, okay. And in terms of additional support that you'd look for from a promoter, I guess we're generally speaking not talking about pure single asset financing or project financing. In most cases, are you looking for additional balance sheet support from the lender or from the promoter?
Yes, we do that. We do look at that. Generally, each case will present itself in a different way, depending on who's the promoter and their capacity. But this would vary from one promoter to another. Of course, as a commercial bank, besides the debt part of it, we'd also encourage you to be with us. There will be other value add in this relationship
Yes.
that we support.
Through transactional banking. and
Transactional
everything as well,
banking,
to ensure.
we do that. We also have a specific asset finance besides the working capital and the capex
Okay.
to facilitate on the importation. Other things are like the trade finance.
Yeah.
We do come in strongly so that you're able to acquire any materials from outside that you require.
Okay. And Godfrey, I mean, I guess a lot of developers who will be sitting here will own the land, you know, possibly have some equity that they might be able to put in, or they might have another JV partner that could join in, but doesn't necessarily have a very significant balance sheet to put behind a development. How does the IFC look at that, and to what extent will you lend on projects where you don't have significant additional balance sheet or cash flow support?
Yeah, I think the fundamental premise is that the project has to be able to stand on its own feet. So I mean that the starting point really is, land equity on its own is not necessarily enough. I mean, you might find a sponsor who says, "I've land, can you provide the balance of the of the funding?" But I mean, what is that land valued at? What realistically is it worth? Because I mean, market value can be debatable.
Yes.
I mean, under distressed conditions, that value can become meaningless. So I mean, we obviously, from a benchmarking perspective, have a view on what the land percentage of the project cost should be at a maximum. It can be, you can't overvalue the land on that basis, but cash equity is important. I think at the end of the day, I mean, just going back to my colleague's, pronouncement earlier, this is cash flow based lending. So at the end of the day, the premise is not, the point of departure is not really whether it's a 50-50 debt to equity ratio or 70-30 or 30-70. It's about what debt can it carry.
Yeah.
And then you work backwards to determine what the capital structure is. I mean, for a very expensive project, it might mean that, the sponsor has to put in much more equity if we are going to finance it, and obviously we are comfortable with, what the market, that there is a market for the project. But obviously, I think it's about reasonable costs and reasonable alignment with what the market can pay for the project. But also fundamentally, for us, when a sponsor presents a project to us, what we are financing is the steady state or the stabilized project.
Yeah.
I mean, if you look at the projections, what we are after is the stabilized project which will pay or repay our debt. So as much as we don't take, I mean, she mentioned construction, I mean, not taking construction risk. For us, the way that we manage that is we want the sponsor to stand behind the project until there is physical completion and also what we call financial completion. An incomplete project is no good to anyone, to the sponsor, to the lenders or other stakeholders. So it is important that we get a sponsor who has the capability predetermined upfront, that they will be able to ensure that the project is physically complete, but also to ensure that the project gets to the point of stabilization, which is obviously subject to a couple of financial tests. And then we're able to take the market risk thereafter.
Okay.
If I may comment, in such a situation where they look for a complete project, we're able to work together with the DFIs as KCB, and what we do, we'll provide the bridging finance, and after completion, then we are able to pass on the project.
Great. Okay. I guess Oteng, that's often where you could come in with some final mile financing as well on these type of projects, I suppose. Yes.
I think we definitely are there for the construction risk most of the time. And as Jeffrey had alluded, it's really a function on who the developer is and who's actually going to do the actual construction, the experience, just like in any other business. And once we make ourselves satisfied with that, then we just go ahead with the project.
Okay. And you know, I guess one of the challenges that lenders have always had, certainly the banks that have strong real estate teams where hotels are still a relatively small part of the overall lending, is the natural fluctuating cash flows within the hotel sector. How do you, maybe Sarah from an Afreximbank point of view, because you often come in post development, how do you work with a development partner or an owner and recognize that the cash flows for hotels are going to fluctuate over the life of an investment?
Okay. So in most cases, what we do is we require that there's a debt service coverage ratio, which has to be maintained over the life of the repayment period. For us, in most cases, the maximum repayment period after we take over the operational risk of the hotel is 7 years. So what we do is we agree before we take over what that ratio will be, and then we monitor it over the life of the facility. But we do work with the promoters as well as with the hotel management we all know that in most cases, what we come up with before the hotel begins operations is different from what actually happens during the operations of the hotel. So we do work with them hand in hand to ensure that the ratios are maintained or there's enough cash flows to repay the facility.
And do you find yourself restructuring debt quite often during the life of a hotel project?
Sorry, come again?
Do you find yourself restructuring the debts or reshaping the repayment profile?
We've had to do that in some of the projects that we've been involved in. I would like to say pretty much about 90% of them didn't really go as what was planned. So during the life of the facility, we've had to be flexible and restructure the transactions, yes.
Yeah, for us, we do a lot of structuring around that. We will put some moratoriums, and also for a mass facility, we can come up with a PIK, which sort of defers some of the interest payments. Okay. And also we have different structures where we can have ballooning repayments, where essentially as the project stabilizes, you start paying us more. So there's different levels that we play with, and really for us, that's the value that we think we bring significantly, especially to new developments where before stabilization, we are quite very flexible in our repayments.
Great. Godfrey, you said you've had 100 projects in Africa?
I mean, since I've
yes,
started.
Probably not since.
Not in the past year.
How many of those, out of interest, have you had to foreclose on? I mean, how do you go about dealing with hotels in distress in markets that might be oversaturated, which you hadn't anticipated before?
It's a mixed bag. Well, obviously, I think the hotel sector is quite a risky sector. Because you're not only looking at the internal aspects of the project itself, there are external shocks that the hotel sector is susceptible to. So, I mean, the structuring is key right from the beginning, so that you ensure that you structure the project to ride the good and the bad times. So I think from that perspective, it helps minimize, distress cases, but not to say there are no instances of such cases, but in instances of distress, typically for us, we have industry expertise in-house. I think my colleague Bernard Mikalef, who work with the investment teams in terms of having a deep understanding of the hotel market, both from an operational and development perspective. So that input is highly valued by our clients in terms of, you have a developer who's talking like for like with their peer that knows the operational aspects. And that I think helps a lot in terms of, bringing an understanding of how to turn around such a situation. So for us, it's not about, if there's a situation we pull the plug. That is not the case. We try and work with the client to ensure that the project can, turn around. But obviously, a lot of the spade work starts with the structuring right at the beginning of the project.
Okay. So starting point is make sure it's a sustainable capital structure, reasonable financial projections, the right level of cash flow to service debt cover, and then afterwards being flexible and working with clients in partnership if things do go wrong. I think we've got about 5 minutes, so love to have a couple of questions from the floor if anybody has some questions for lenders. Philippe?
Don't be anxious when I have the mic. No, I would like to touch on a point which is linked to the green aspect of the hotel project, environmental standards, which are more and more required in a lot of brand standards, and also on the corporate social responsibility that the project and the brand or the operator are going to implement. So to such extent, do you make these aspects as conditions to the loan or to the financing? And also beyond that, do you have even incentives, maybe Proparco, do you have incentives when the project comes with some social aspects, whether it is communities, training? So I would like to have your positions on that.
Yeah, it's definitely a criteria. We are not focused on one specification or certification specifically, but it's definitely a criteria for us to enter into a project. And in terms of support brought to the promoter in that aspect, we do so. We have assisted several of our counterparties with technical assistance programs to help them either assessing their impacts, so putting in place some kind of reporting tool, or upgrade the standard of their project in terms of environmental certification, or obtain such certification. So this is something we can bring in addition to our financing, an envelope of technical assistance.
Yeah, I think if I can comment for IFC, I mean, for us, when you look at a project, it's about, how do you maximize the development impact? And obviously, there are certain interventions that we've been very active on in terms of mainstreaming them for the benefit of the wider market. For example, from a sustainability perspective, we've developed a tool called the AHIF tool or platform, which focuses mainly on savings on water, energy, and building materials. And if you achieve a minimum of 20% on each of those, the project qualifies to be EDGE certified, and it gets a formal certification on that basis, which obviously is of benefits not only from an operational perspective, but also from a marketing perspective. I mean, climate change is real, and there are obviously interventions in terms of, how do we start to engage on that, or mitigate against that, for the future. So that tool is something that is really evolving into multiple sectors, not just the hotel sectors.
Sure.
So we would work with our clients on that basis, and they have access to our expertise in that domain. And this is a tool that is available online for free to developers, and they find it quite useful. I mean, I can mention, one building close by here, which is the Britain Twin Towers, which has recently been ACE certified through the efforts that we've had with the client. And Radisson Blue, who obviously are the brand for this hotel, also subscribe to ensuring that their development or developments that they are engaged in EDGE compliant, and a lot of other international players. So
okay, great. So that's the EDGE program from the IFC.
Yeah,
certainly one to look out for. Thanks for the question, Philippe. Any other questions? expected. Ah, here we go. Tom in the back.
I've always got a question for you, Xander. Is there any changes in market entrance in the last couple of years, and how do you see the trends over the next couple of years going forward in terms of competition within the market and just the players within the market, local, international? How do you see it panning out?
Yeah, well, I think on the lending side, certainly a change that we're seeing in the more mature markets is that you have more generalist investors coming in. So with that, there's been new banking relationships that are now looking at hotels, which wasn't the case before. I'd say the DFIs have always been a very strong part of it, and the bigger banks like KCB, but certainly in places like South Africa, Indian Ocean, and some of the more mature markets, we are seeing new banking relationships being brought to the sector, which hopefully over time is going to increase the depth of the lending pool as well. So, yeah. So thanks for that question. We're pretty much out of time. Final question for everybody on the panel is, in terms of your exposure to the hotel sector in Africa, performance has been under pressure. There have been some oversupplied markets. There's still lots of opportunities. From your perspective, are you bullish, conservative, or making a run for the woods in terms of lending in the hotel sector?
I think at the moment we have appetite for the sector. Mm-hmm. We have a couple of names we are working on, and we are keen to push them to conclusion.
Right. Fairly bullish? Godfrey?
We're open for business. I think there's a renewed focus on tourism given its capacity to generate employment. But our key focus is, is there supply? Is there demand, given the supply that is coming onto the market, and ensuring that, the project is sustainable. So we have appetite, but we are quite selective on the parameters that I mentioned earlier on.
Somewhere between bullish and conservative, but looking for sustainable projects. Good. Claire?
We are clearly bullish because we are convinced that hospitality is key to job creation and to create a good environment for business in markets. But we want to remain subsidiarity, so we won't go on mature markets if there are commercial banking offer sufficient to support those projects. So we are more focused on least developed markets.
Okay, so bullish but true to your DFI focus, which is to focus on regions where others aren't. Yeah. Great. Oteng?
Yeah, I think we are somewhat bullish also. There's been key developments generally from a continental standpoint. Number one, accessibility. I think more and more countries are dropping the visa requirements, or you can get the visas at the airport. We believe that's going to drive a lot of traffic towards hoteling. Then access to airways, essentially infrastructure development or government allowing non-local airlines to participate in those industries where they create new corridors to actually deliver people to areas that had not been traditionally visited. So based on those changes, I'd say we are bullish about the sector.
So fairly bullish, very much driven by the underlying demand fundamentals of the tourism sector. Yeah. Great. Sarah?
I would say we're bullish as well. Currently, under our refinancing undertaking arrangement, we've supported about, I would say, close to about 220 million worth of financing. But that has mainly been in West Africa. And we have 50 countries that we have to do business in. So we need to roll out the program in other regions of the continent, in Southern Africa and especially East Africa. So there's quite a lot of work for us to do.
Okay, great, good to hear. If you can just join me in thanking the panel for their feedback.
Sorry, just one question, please.
Perfect.
Supposedly, as Friday, they're looking at an aggressive expansion plan going on in the various regions
some strong questions there. I guess the first one is there anybody who would not be looking into any regional expansion in Kenya? Because it's certainly something that I think everybody's been talking about.
Given the structure of our government currently, where we have devolved units, would be very keen to look at those, at the investments outside Nairobi. That's something we can discuss, even outside this meeting, but we are saying would be keen to support you, particularly on that proposition of expanding outside Nairobi and in the region where we have a presence. Okay. That we can do.
I know it's the same, certainly for Godfrey and Afreximbank, who've already mentioned that. I guess LTVs, we largely talked about 50%. Perhaps on a portfolio basis, it might be a little bit different. So it would be worthwhile having a specific discussion on that with some of the panelists. But I'm aware that we're a little bit out of time, but I'm sure they're all going to be here for the next couple hours anyways, as named, if you want to have some more specific questions for them. So thank you very much, and I'd just like to invite the investor panel to come up.
Thank you.
Thank you.
So I think just in summary, whilst we're getting things prepared, from a lender perspective, clear messages, absolutely come prepared. They're looking for a sustainable structure, very much driven by the underlying tourism fundamentals and demand. Come early because it takes long. That's certainly our experience in terms of dealing with quite a few of the lenders. They do view it as a partnership approach, which is good to see in terms of riding through the different cycles. And on the whole, they seem particularly positive. So keep on reminding them of that as and when in your applications.
Oops, forgive me.
Great. Welcome to the stage, gents.
Thank you.
Very pleased to have probably what's been one of the strongest investor panels that we've had for a few years. So very pleased by the caliber and range of investors that we're going to be talking to today. And these are the guys that are really putting their own money or the money of their principals behind things. So this should be exciting. In terms of who we've got David from Casada. Am I pronouncing that correctly?
Yep.
That's a new Accor and Qatar fund. He's got about $1 billion in his pocket to spend on hotels, if I'm not mistaken. So it'll be good to hear on how you're going to be doing that. Ewan from Westmont. Those of you who don't know Westmont, I think you're invested in 600 hotels or so around the world?
A bit more, but...
More. Okay. Well, let's start with 600. So they've certainly got a lot of experience in this region. Amici from Limestone, who's based in Lagos, has got various different investments in the hotel sector, from property to operating companies, so very much a diversified player. And Nimit from Helios, who's more of a generalist PE player. Is viewing the hotel sector a bit more opportunistically, perhaps, than some of the real specialist investors that we have on the panel here. Focus is very much going to be about where's the smart money going, what challenges are we facing, and what sort of opportunities are we seeing. So, on that, David, how do you go about figuring out a strategy of putting that type of volume of money into the hotel sector in Africa?
Thank you. Quite a lot has been said about the $1 billion that we have to deploy. It sounds pretty enormous, but the reality is it's an industry that has quite a bit of scale. So if you take a step back and you look at the industry, it's got scale, it's capital intensive, okay? It's growing, and it's extremely fragmented. The majority of the promoters are quote-unquote high net worth individuals. So from any type of investment standpoint, looking at a sector like that, there's an opportunity to create a platform with scale that can come in with an institutionalized approach. And within that platform, bring different skill sets that have never been put together in terms of providing capital to the sector in Africa, which is from the investment team in financing and analyzing and financial engineering, to the development side, to the asset management side, and even to the construction side. So putting all that together with a sponsor like Accor, we think we can kind of extract synergies, make it more efficient to deploy the capital. So I think that's kind of the broad premise as far as where we exist, and I think it's probably going to be the beginning of potentially the institutionalization of the sector from an investor standpoint. And then from a strategy perspective, sure, it's a lot of capital, but as I said, it's capital intensive as a sector, and we'll invest across the chain from greenfield, in terms of balance that, to brownfield, to opportunistic, even distressed situations where we can take on hotels. So if you look at the different verticals where we can deploy our capital, it's actually quite scalable and sizable.
And you're looking to play, pretty broadly in terms of the investment space, right? Like you said, whether it's new builds or whether it's JVs or coming in towards the end of a project to finalize it. Okay. Ewan, I mean, as Westmont, you've been active probably for about 3 years now
That's correct, yeah.
on the continent. Haven't done that many deals yet. I think you guys are, very focused on finding the right deals for you guys. You've just closed the acquisition of the 4 Points in Lagos, so congratulations on that. Why did you go for that acquisition versus all the different projects that cross your desk?
Thanks, Xander. I think what we've done is we've been assessing the opportunities almost at a zip code, postcode level. We like business hotels. We like to be in cities and major demand nodes. And honestly, if you look at what we did in Europe and we did in North America, we would like to do some acquisitions of portfolios and repositioning. Yeah. And we're looking towards GLL and other brokers to encourage more real estate to come to market. I think specifically why Lagos. Lagos has gone through a difficult time. We think the fundamentals are strong, from economic to political to populous. And if you look at the number of other factors of consumer spend, diversification, etc., we think it's a good market to be in. Secondly, to be absolutely honest, the building industry has really made it astronomical to do new build, and that barrier has, in many markets, has just become too high. Yeah. So, we saw an opportunity to buy an existing asset, very well positioned, well supported by the brand. It was an easier purchase than trying to do a greenfield or new development in a market we wanted to be in.
Yeah. And from an investment model, that's very much what you're looking for, so kind of value add type opportunities where you can acquire below replacement cost or add significant value before an exit?
I think it's a dimension. I think you need to look at the fundamentals of the market and where the demand curve is. What I'd like to see more of is sophisticated investors. I'd like to see people coming into our industry, investing, developing hotels, flipping, moving on, growing a portfolio, and having a more sophisticated market. I think, we can all talk about cities that we think are oversupplied. If there was more transactions in those markets, it would then allow them to become a bit more sustainable, probably, a bigger diversification of brands as well as product offerings. So I think for where we are this now is we're trying to encourage more transactions to come to market and encouraging investors to say, well, at that year 5 or year 7 figure to exit, there are buyers out there, there is equity. Before, maybe it was more difficult to see an exit. I think now I'd like to believe that there's more opportunity to sell and to reinvest.
I guess with new players coming to the market, you're looking for additional liquidity, which should give some more pricing transparency as well, right? Because I think most of the discussions and arguments we have together with everybody on the panel is around where yields are sitting, where cap rates are, what the right pricing of assets is, and hopefully with that increase in volume that you're talking about, is going to be more comfort for investors that they're buying at the right levels and the right spreads. So that's great. Amici, you're as far as I understand, you have a fairly broad investment strategy. How are things looking for you at the moment? You're Nigeria-based. Ewan's just transacted there. Where do you see the opportunities?
Well, we tend to focus on West Africa. Let me start with that. And within West Africa, we are moving now towards investing in assets that are not just business class assets. That used to be our focus, where we were primarily focused on business style hotels. We're beginning to see an increase in intra-Africa travel across the region into West Africa, and we are beginning to see West Africans themselves seeking resort holiday destinations within the region, so that we're shifting focus, or at least we're beginning to pay attention to that asset class within the larger hospitality asset class. When it comes to investing for us, per se, we tend to look at things from both a macro perspective and also a very micro one. We are very focused on locations or places where we find the government's interested in promoting tourism, in promoting travel into their region. We find that the discussions are easier around the assets when you have that. And of course, on a very micro level, where you're talking about, at what stage is the asset at? What is your, what is all the analytics around it? Is the demand there? What is the supply doing? What is the pricing doing? Oftentimes, we find that some of these distressed assets that we come across tend to be priced to the level of the distress, which isn't usually the market pricing, at least as we see it, and that disconnect tends to limit the number of investments you can actually call viable. Yeah. In the end, we like to see our investment module as one that at the early stage we are looking very closely at the risks associated with the asset. We're looking at how that risk can be dispersed, what risk we want to retain, okay, and then if we get past that and we get into the acquisition mode, then we're very interested in looking at how we can execute, okay, to the pricing that we think is accurate, and how we can sustain that asset and make it more competitive because we own it. Yeah. Okay.
Okay, so very much I guess when we're looking at investment strategy, starting off very much with the fundamentals, the macro side, again, the underlying tourism, the regional demand, domestic demand, then going more into the micro, the street corner, and the asset. That's
absolutely
very interesting. And Nimit, I mean, from your point of view, you're not the sort of guys that will go in and buy a single asset and hold that and flip it or exit it after a while. I guess you're looking more at platform type of plays. When you're looking at the hotel sector today, what are the sort of investment opportunities that would excite you guys as Helios in terms of coming into the sector?
Yeah, so as you said, look, we're a generalist investor, but we try to be quite thoughtful about, at least picking an investment thesis within a sector that we like, and then finding some strong operators, right? So typically what makes sense for us is to find someone who has some degree of track record, and that might be within the company, it might be elsewhere, and then applying that to as you say, a platform strategy. So let's pick some operating assets and some individuals who know what they're doing and have an aggressive growth agenda, and then we'll back that with growth capital. We've done that both on the equity side and on the debt side. On the debt side, we've done that specifically within the hospitality space. On the equity side, we've done that in a lot of, I would say, sort of related sectors. We have a strong operator where you have potential for significant improvements, particularly on the cost side. So, a more efficient build, more efficient management of the assets. We've done that in the student housing space, broadly affordable housing, actually, retail, telecom infrastructure, and I think it's really trying to take that journey with experts, where you go from really sort of in the weeds trying to build an operating asset to building something that in 5 to 7 years we think has enough scale to go from being that kind of, you know, work in progress to something that we can then find a larger home for. And, you know, we've done that within the public markets, within the retail space. We've done that to a strategic operator. And so it's really kind of finding that sweet spot in the journey of that expert, where we can back them with an aggressive growth agenda.
So it sounds like a good sort of partner would be somebody who's rolling out hotels in the counties in Kenya. Excellent. I mean, David, on your side, if we just focus on the fundamental side, are there any particular kind of big trends that you're looking to capitalize on? Is there a particular space within the hotel sector that you want to play in or not want to play in?
I think the core of our focus, obviously we have a decent amount of capital, so you'll have kind of a normal curve or the portfolio distribution, but the thick middle, effectively, it's going to be the mid-scale to economy space, which is where we see the most amount of opportunity, which is where Accor has seen the most amount of opportunities as well on the continent. So we do benefit from that internal strategic research that a sponsor as big as Accor has done. So this is where we see the biggest one, and we like to say, kind of following the emerging African middle class across that. So case in point, if you look at the hotels that Accor has in Sub-Saharan Africa, a large percentage actually of the visitors in these hotels is actually intra-Africa travel. So that's going to be the core part, but again, linking a bit to what Nimit has mentioned is, you know, in order to deploy scale, you don't necessarily want to be doing one single hotel at a time. So you'll probably see us build more country or regional platform around with potential co-investors as well, in order to build that scale across.
Okay, so very much in keeping, I guess, what Nimit's saying around platforms, what Amici is saying around, you know, focusing on regional and local demand as the underpin really of hotel performance, rather than necessarily, you know, looking at that top slice of the market, which might be foreign travel as opposed to domestic. Yeah. Okay. And I mean, you talked a bit about liquidity. Pipeline realization is still relatively low. Liquidity is relatively low. I think this year our estimate's probably that there's going to be about $350 million worth of assets traded in Sub-Saharan Africa. Maybe next year it's going to be, you know, 400, 450, around that mark. But by international comparisons, it's still low. I mean, when you look at investment opportunities, what's the biggest challenge you're finding at the moment as Westmont in terms of deploying your capital into the region?
I think it is partly that. With regard to this, there's just a lack of targets in the market. Secondly, there's a misalignment with regard to price expectations, and you've got to be sympathetic to that. You know, if somebody has had a dream, put together the project, spent double or triple the amount of time building than they anticipated, spent a lot more money on equity, capital, interest, all the different elements of the capital pile, they're then sitting there with this huge, long list of numbers on the spreadsheet, and they go, well, I want to sell it. That's what I want to sell it for. Yeah. And then along comes us, and we say, well, it's a hotel. It's got one purpose. It's to generate an EBITDA. Let's look at what that multiple is of EBITDA and try and calculate a fair, reasonable value for what that asset will generate in the future. And those two are polar positions sometimes. So, you know, I think as an industry, we need to be, as Godfrey said in the last panel, we need to be absolutely realistic in our expectations. I think there needs to be a far stronger control around the build process to make sure that what you conceive is what you receive, if that makes sense. And, you know, holding the contractors to fixed price, fixed time, so that there's less of that time, because, you know, time costs money, and that just drives up the pile. So that when you then have an asset after, you know, Elias comes in, looks at it and goes, right, we've invested at day one, it's 5 years down, it's now got good earnings, it's a sustainable business, can we sell it? Come and talk to us or talk to other investors. That's when you can have a realistic price discussion. But I think this now is that gap. And then the third thing, I think, is just being in a position where the barriers to entry are not too high. Today there are countries in the continent who are very good at marketing themselves, but when you actually think about just the movement of cash, you know, day one investing, if you put your money in, can you get your money back out? Without too much cost or too much friction, that puts you immediately off. So those countries become, you know, outliers because it's just too difficult. Let's look at where you can easily move capital. You don't want to always have to borrow domestically because, again, as you saw in the last panel, the cost of local debt can be prohibitive.
Yep.
So you want to be in a position where you can move foreign debt over border to achieve those efficiencies, because ultimately every percentage is an erosion of value.
So I guess one of the key challenges is pricing expectations of sellers, pushed up by development costs, unsustainable development costs, and possibly not the right type of capital structures going into it. Do you think that if you look at international investors coming into the sector versus domestic investors, do you think that international capital is pricing risk correctly in Africa?
If you go back to 2008, 2009, you could go to international investors across the world and people were getting excited about Africa. And that was because there was this belief, and bless you, I put it down to belief maybe rather than maybe the data, but there was a belief that there was high risk, but there was also high returns. And that was where the international investment community, I think, was maybe back 3-4 years. We have, as a continent, gone through some big adjustments. And some countries are now at different positions in their kind of growth cycle and trajectories, etc. It's harder now to clearly say the rewards justify the risk. So I do think that domestic or localized investors have an advantage in some respects, because they are less distracted by other opportunities. They're here, they want it to work, and maybe their expectations of return are less. Trying to get international investors to come in is difficult. But again, if you've got the local insight and use that to your advantage, you should be, theoretically, a better investor if you're a local investor.
Yeah, David, your thoughts?
I think that international investor versus local investor is always a fascinating thing to observe, because you have very often a kind of a paradox in the view of risk, right? An international investor will come into a jurisdiction and usually have a currency in their pocket that's probably a hard currency, a euro, dollar, right? So that already is a different viewpoint than the local Naira investor might have. And secondly, as a Pan-African investor, you also have a view of risk that you apply on a risk-adjusted basis in different countries, right? So you're looking at Kenya, and interestingly enough, these countries tend to not be so related, where investors in one country might have a view that that asset might be worth a lot more than even in another country. So Kenya is known, for example, to have quite a bit of asset inflation. So it's about kind of assessing that from a risk perspective and knowing where to deploy your capital and effectively arbitraging that.
Yeah, interesting. And I guess there's a thought as well that if you're an investor based in Nairobi, that even though in some way the risk might be less in Southern Europe today than it is in Africa, if you understand your street corner, you understand the political risk, to an extent you might have some influence over it, that may actually be fundamentally lower risk than going cross-border, where international investors who are geographically agnostic might take a different view. I mean, Amici, you're quite focused on Nigeria, more and more into West Africa. What are your thoughts on how you can price versus others?
Well, I've always been of the view that local investors carry some level of advantage over the more global investors for a variety of reasons. They do have some disadvantages, and I'll come to that in a minute. The advantages they have, of course, are that they are local. If they are engaged in the market, then they know the trends, they know the statistics, they know what the numbers should ultimately be in terms of a return. And any global investor coming into the market will have to learn that. The local investor disadvantage tends to be from a cost of capital point of view. Okay, and the fact that they don't have access to a diversity of capital sources, which means that their own capital tends to be priced a little higher. And therefore, when it comes to pricing the asset, they are at a disadvantage. That is, in a sense, if they have to make a return on the cost of capital, then they have to price a little lower. But if you come to where is the best point, where is the sweet point, it is the global investor teaming up with the local investor. And if you can create those kind of situations, then I think you have generally better access to markets. You have generally better access to the quality of assets that you get engaged in with respect to acquisitions. And if you've got a local partner who's also a good operator, then I think, or a good asset manager, if not even an operator, then I think you might have the best of both worlds. That's generally how I'd like to think that we go forward with this. And then one last point on this thing is that I think that the time is actually now for either Africa-focused or regionally focused investment funds, pooling of capital that disperses investor risk and allows for geographic dispersion of assets that get acquired into the pool. And I think that if one can do that, underpinned with global and local capital and global local partnerships, I think you might be onto something that's winning.
Great. We spend a lot of time with our investors on exactly that, right? I think it's, if you take the investment community globally, then they're a little bit their own worst enemy, right? Because there's euphoria or there's depression about Africa and it's all, and the reality is, the line is like that, but it's, what we spend all our time doing is trying to convince people, at least on the investor side, is that it's an upward sloping line, and that slope, if you invest in the right types of opportunities and not try and pick the cycle, then you're going to be in a good space. So I completely agree with that. I think the challenge is then you've got to be quite deep in the weeds, right? And so you can't try and do 100 things. You've got to find local people to back and really play that sort of secular trend. And I think for me it's almost a distraction to think about investor sentiment globally, because I think the true global investor is candidly not even focused on Africa, right? So they're looking for other stuff.
That's a very valid point, yeah, for sure. And I mean, picking up on something else Amici said was kind of the institutionalization of the sector. Maybe a question for David, because to an extent, you're one of the key new players coming onto the market, including the likes of Westmont and other players. Do you see this as the start of a new cycle where you are seeing a lot more consolidation in our sector, and where vehicles are being formed that are going to facilitate institutional investment rather than private investment to the sector?
I think it has to be, right? I think being an investor way back in the US and now for the past 12 years solely focused in Africa, one thing I've learned is that once you have a view of what's going to happen, for example, in this case, institutionalization of the market, it always takes a bit longer than you would probably naturally would expect. But I think that it's just a very natural progression, like I mentioned earlier, for a fragmented market that's capital intensive, right? I'm sure the Westmont guys, you operate outside of Africa in a very institutionalized market with large transactions that are being done. So the same way private equity has become institutionalized in Africa across general industries, I think that is just a natural step, and hopefully a vehicle like ours is just one of a few more that'll come into the market. And the more you institutionalize it, the more efficiencies you can take out of it. The more the panel before, I think, was kind of the key as to why there's so many issues and inefficiencies in this sector, which is financing, right? So sitting at a desk as an investor in Africa, the entire time the sector comes to our desk is very often because of broken capital structures. Yeah. Not necessarily because of broken hotels in terms of business model, but broken capital structures. So if already institutionalization brings that and effectively smart investing comes to that, maybe some projects don't get executed, because it's not necessarily, the institutional investor doesn't look at trophy assets in some ways. So I think it's helpful for the entire community, including the banks that will be financing projects, and all the members of the panel as well.
Great point. We've got 5 minutes left for some questions, so I'd love to take one from the floor. Cherry?
Hello. Jan, you touched on it from a part of the efficiencies of the development life cycle to try and get the costs of hotels as low as possible. A lot of time does get spent in the design stages or during the construction stages, which really does push up the cost. My question really is, with my experience, there's a lot of focus from investors in trying to get the capex of the hotel as low as possible, and if that takes an extra 2 years, 3 years, 4 years, the measure is the capex that's been invested in. So my question is, in terms of, does anyone on the panel have a sense of the sensitivity of the time value of money? So if a project goes on for an extra year, what is the result of the payback of that, of those assets?
Great question. I think probably the most passionate about this is Ewan.
I think you have to plan, Terry. I think the most important thing is before you get on site is absolutely lock down your numbers. If you are working with a global brand, I think my advice would be is look at the brand standards and have a real, genuine, detailed, granular discussion about what really is the most appropriate fire life and safety solution for this location. Because the standards are global, they're kind of generic. I'm not saying you're going to get lots of concessions, but I think you need to be very specific on making sure that what you put in this building is absolutely essential for economics as well as for the brand and the guest expectation and the safety. And I think you need to put together the right team. And I think the project managers need to take a bigger role of being accountable, to be honest. I think a project manager needs to be accountable for genuinely working on behalf of the client to make sure that the project comes within budget, and absolutely holds the professionals and the contractors and the subbies accountable for delivery to that timeline. I think the days of having a project manager who's setting up meetings and providing information and communication has gone. I think there needs to be far more control by the PM. I think that's what I would ask for. And then finally, absolutely, every single day of delay has a disproportionate impact. Not just with regard to the cost of cash, to be absolutely candid, in sheer commercial terms, the market. The very consumer you want to bring in starts getting skeptical about it. Has that hotel ever going to open? Is there actually going to be what's going to happen when I go there? Is it going to be a good experience? When do you negotiate your rates? All those kind of things start becoming an issue. The general manager, you've employed him for 6 months before opening, he's still sitting there idle, effectively not generating revenue. So it's disproportionate, and I think you need to bring that to a head as a project manager and stop it and get the business open.
Great. So I think that was pushed right back at you there, Cherry. Another question from the floor? Right, then I think, a question from Tom.
Sorry, I'm that really annoying person who always has questions. Thanks very much for that panel. I thought it was a really good, clear, succinct answers to the questions. And there was a particular point that you made, which was very clear, which was the distance between expectation of pricing, essentially because of overcapitalization, and then the reality of the income stream that can be generated. Do you think there's also another part of that equation? I think, Nimit, you got onto this as well, which is capital that comes into Africa, particularly international capital, tends to underprice risk by underpricing volatility and underpricing liquidity, and therefore gets burnt. I think the reason it does that is because the calculation of risk-free rate is often taken at a spot price, is often taken from a Eurobond, and is often completely manipulated. How do you, as investors, get the right calculation of actual risk in the market as relates to both liquidity and your risk-free rate? How do you smooth it? How do you get it right? And how do you not get burnt when the markets turn?
Oh. That's why we get paid the small bucks. We get paid. No, I think it's, look, it's a very good question. I think that's maybe a little bit what I was saying, is where I think to take a macro view on Africa or a country or a region is, in our opinion, exactly the wrong way to go. And I think if you try and actually do those calculations, the reality is there's just not enough data out there to give you an appropriate answer, which is, I think, a little bit where you're headed, right? And so I think, how do we then get our head around it? I think we try and think about, okay, what are the biggest external shocks one can have? If it's a country that's resource dependent, let's try and build that into our thinking. For every one of our jurisdictions, foreign exchange is the other biggest issue. And so how can we create some effectively shock absorbers within the system? Try and maximize the amount of local costs, local funding, and try and build a business that, to the extent that you can, is dependent also on domestic demand or fixed revenue stream. So the hospitality asset we have has a long-term contract from a big operator. So try and at least make sure that recognize that any one of our economies will have quite a bit of volatility within the system, and what can you build around that to make sure that your balance sheet effectively can sustain that. And it's an imperfect answer. I think that's part of the answer. The other part is you better make sure that you're buying at a cheap enough price to build in some of that cost. That's the only. It's imperfect, but that's I think the best we think we can do.
I might have something to add to that, actually. I think that we need to make a clear distinction between what I call time-based capital, which could be sort of private equity that needs to exit, and more longer-term or more permanently focused capital. At every point in time, I think you're going to find a little bit of a mismatch between pricing, risk, and return. But over the long term, over a very long term, I think capital markets are robust enough that the pricing is right. On a day-to-day, year-to-year basis, you might find all these discrepancies. And the problem then becomes, if you are time-based, or your capital is time-based and it's got an exit point, okay, then you might be creating the problem yourself, because you are in it on the assumption that your pricing, okay, is reflective of the risk. But remember that these markets are dynamic, time is, events change, so pricing catches up with events, okay? And if you are exiting, all right, at, say, a time where capital is bottlenecked in one region, then you're gonna have a problem, okay? But if you are there for the very long haul, I mean, let's take East Africa, for example. A lot of the capital in the hospitality sector has come from the Middle East. It's come from India. This kind of capital has been around 30 years, 50 years, okay? I bet you their answer will be very different if you ask them, are you making a return on your investment, than if you ask the private equity guy who invested 5 years ago on the basis of certain assumptions and has to be out tomorrow. Okay, I think you're going to have very, very different answers to that.
I think a pretty fascinating discussion, which we could take on all day. So thanks for the question, Tom. We are very much out of time. I think just quickly to recap, it certainly feels like we're in an evolutionary point in terms of the type of capital that's looking at hotels, and whether that's more institutional or more global, but certainly within that, local partners and platforms are still very critical to efficiently deploying capital, understanding risk locally, and hopefully through that introduction of new capital and new skill sets coming in, we're going to see more efficient capital structures, smarter investments, and hopefully better priced assets. So thank you very much to the panel for your time.
Thank you.
Thank you.